Greetings. Today is Tuesday, April 2nd, 2024, and this is our monthly market monologue where we're going to talk a little bit about the markets and what we see, as well as some economic data, and we're especially going to talk a little bit about the dangers for conservative investors. So that said, let's just dive in. On the screen right now, I have 4 ETFs. We've got the Mega Cap, the Vanguard Mega Cap ETF, leading the charge year-to-date performance through the end of March of about 12.4%. Then we have the S&P 500, the traditional cap-weighted ETF. And then we have mid cap and small cap. That is your year-to-date returns for those 4 broad asset categories. But let's take a look and dial in and just look at the month of March, and we can see a little bit of a rotation. We see mega cap actually lost a little ground with a negative return in the month of March, but look at small cap. That's VB, the Vanguard Small Cap ETF, leading for the month of March. So this is good news. We've been talking about this in our Good Friday video. We talked a little bit about this. So now on the screen we have a different small cap ETF. This is IWM, the iShares Russell 2000. And in my video from Good Friday, we talked a little bit about this measurement down here where we have the percent of the stocks in the Russell 2000 that are above the 200-day moving average. We had a downtrend. This index, or this measurement rather, this breadth measurement broke out and it's consolidated. It's closed the month of March in a very good position. So this is really good news because, as we have been discussing, in order for us to have a robust bull market, we really need to see the small cap stocks participate. Here's the catch though. Both April 1st and then again today, small caps have indeed struggled just a little bit. So it's too early to tell if the small cap is really going to be the new leader or if they just had a strong month. Next up, we have the Value Line Geometric Index. And this is another way that we're measuring the overall breadth of the stock market. And we can see this green line. We finally broke through that. This is a weekly chart. So again, this is another sign of improving market environment when you have the value line also breaking out. This is our seasonality chart where we're showing the average monthly performance for the S&P 500 since 1950. You can see that historically March is on average a pretty good month. March 2024 was very good. You can also see that April is historically even better than March. But let's dial in and look at small caps and that same type of seasonality chart. So again, this is the small cap 600 index. Notice the average monthly performance only goes back to 1995. That is simply because prior to 1995, a small cap index didn't really exist. So you can see March is historically pretty tame for this small cap index, but this March was very good. But then take a look at the month of April. So it remains to be seen whether or not April will be as strong this year as it has been historically, but the historical precedent certainly is encouraging. But this is where we want to start to transition and talk a little bit about the risks for the traditionally conservative investor. And first up, we're going to look at inflation. So the last several inflation reports have come in within line of expectations. However, one of the things that really concerns us is some of the things that we're seeing underneath the surface that's not yet showing up in this data chart that is giving us a little bit of a concern that inflation might very well be ticking back higher. And if that is true, that causes some concern for both stock market and bond market investors. But today we're going to focus on the risks for those conservative investors who are relying heavily on fixed income or bonds. On the screen right now, we have the ticker symbol AGG. This is the iShares US Aggregate Bond ETF. We're going to use this ETF as a proxy to help facilitate this conversation about the risks that your traditionally conservative investors are facing right now, and the reality is for the last several years. For the last 50 or 60 years, the financial services industry has largely preached that as you age, you should increase your allocation to bonds because they are quote unquote safer. For a long time now, we have disagreed with that sentiment, and this is part of the reason why. So on the screen, you can see that this data for AGG, we've got it going all the way back to 2018. This first highlighted section here is the COVID crash. You can see that these bond investments corrected almost 12% in a very, very short time period. Now, again, from a historical standpoint, a lot of people in this industry are recommending a heavier dose of bonds for those clients who are getting closer and closer to retirement, because the volatility has historically been a bit tamer than stocks. And while mathematically that is true, it doesn't mean that it will always be true. And this is one of the big reasons why we believe in actively managing a portfolio for risks. And we believe risk is the risk of losing money. And if we look at the evidence in that COVID correction, bonds suffered some significant volatility, well higher than what bonds have historically done. So just because something historically has happened doesn't mean it's going to continuously happen. That's why we try to give the disclaimer every time we look at those seasonality charts. Yes, historically, April is a pretty good month. It doesn't guarantee that this April is going to be a good month. So when we look at bonds, we see a lot of risk because, again, yes, we had a big correction in bonds during the COVID crash, but they recovered. But look what's happened since then. This is 2020 here, and then in 2021, and it's just bond investors have really struggled just as much, if not more so, than your equity-based investors. And so from top to bottom, we see a correction of 24%. But we're going to zero in and show you this right-hand side of the chart because this is what's really got me a little concerned. So again, the same ETF, I've just zoomed in a little bit to the right-hand side of the chart to highlight what we saw just yesterday. So when we study technical analysis, when we study the price patterns of stocks, bonds, ETFs, etc., what we're looking for is clues. We're looking for clues as to what might very well happen. There's nothing in technical analysis, nor is there anything in fundamental analysis that is going to guarantee an outcome. That doesn't exist. But what we're looking for is the tendencies. So when we see a pattern like this, what is the tendency to happen? And so when I see this bond chart, my eye immediately sees this downtrend line. So we've got a high here. We came back in. We actually made a little bit higher of a high, but right now it looks like what we would call an island reversal. And we have this here is a lower high, and then we see another lower high. And so this is creating this downtrend line. Now on the bottom side, my eye automatically sees this, where we have just the opposite. We have a series, just really a couple of higher lows. And so when you put those two trend lines together, we can call that a triangle. You can also think of this as a coil. I posted this on my LinkedIn page. Again, if you're not following me on LinkedIn, you're welcome to follow me there. But you think of this as a coil that is springing, and we're springing and winding and tightening up into this apex. And what typically happens is the position, the stock, bond, ETF, wherever you see this chart pattern, what typically happens is an explosion, if you will, out of this coil. Again, think of a rubber band. It's snapping, and it's something is going to happen. It's going to coil, or the spring is going to uncoil and bounce up. Well, unfortunately, yesterday, bonds had a pretty negative reaction to the bottom of this little triangle. That is not good news for our fixed income investors. Now, some of the reason why we would contend that we're seeing this is because the stock market participants are slowly starting to realize that their expectations of a lot of rate cuts from the Federal Reserve were probably unrealistic. I think I posted this in one of the recent videos where early in the year, there were a lot of people that were thinking we might see as many as 6 rate cuts this year. Now, we'd never subscribed to that theory. Well, right now, most investors are pricing in 3 rate cuts. Well, that also may not happen because of what we're starting to see, again, underneath the surface of the inflation. So far, inflation is meeting the expectations, but underneath the surface, we're seeing some price appreciation in some of the commodities, which is going to put pressure on the inflation data. So if inflation does begin to tick back higher, we would expect to see some more volatility for both stock and bond market investors. We're highlighting the risk to the conservative investors because if you go back to that chart, what we were showing is the fact that it looked like bonds were finally beginning to heal, especially since probably November 1st or October 30th. But again, some of the recent action is really calling that into question. On the screen right now, we have what we call our VSI. This is our vertical speed indicator. I'm going to go through this relatively quickly just because I know this video is already pretty long. But I'll do a video dedicated to this. Probably in the next video, it will be specifically about this for you to understand this a little bit better. But this is one of the ways that we are making decisions when we're managing money for our clients, is we believe in taking a weight of the evidence approach. There's no such thing as a technical indicator that is going to guarantee a profit or guarantee the avoidance of a loss. That does not exist. So that's not what we're trying to do. But we believe in taking a look at a lot of different data points and drawing a conclusion. If it looks like a duck, it smells like a duck, it walks like a duck, it might be a duck. That's our concept here. And so what we're trying to do with this VSI is we're trying to help avoid the damage of a prolonged bear market. And that's what this is designed to do, is to give us an awareness, an unbiased opinion of the risk underlying the market. Again, it is not designed to help us get out of the market at the top. It is not designed to help us to get in at the bottom. That is not what it's designed to do. It is designed to help us avoid these really prolonged bear markets like the dot-com crisis or the global financial crisis that were multiple years in duration. That's what we're really trying to avoid. But this is just one of the ways that we measure risk in the overall market to help us make decisions when we're actively managing money for a client. Again, I'll go into a little bit more depth in the next video. Hope you'll come back to watch that. In the meantime, I hope you found this video helpful. If you haven't already, please hit that subscribe button, maybe even turn on the bell to get notified when we post a new video. And again, if you have any questions, feel free to reach out to me or my team. We would be happy to see if we can be of service. Thanks for watching.